But this is where now you have to understand, what do you want to get from your investments? Do you want cash flow, or do you want to see more growth in the stock? Because if you're investing in a growth company, like a startup company, they're not going to be paying out dividends. Because if a startup is paying out dividends, that means that they're using their money not to grow the company, but just to make their shareholders richer. And if you're a startup, you want to go out and get bigger. You want to get more of the market share. You want to get a bigger share of the bigger pie out there. And that means you got to use your money to grow quicker and faster instead of just trying to make your owners richer. So if you want to see the big growth in a stock price, well, then you're probably not going to be investing in the dividends. If you want more slow and steady growth, then dividends can be a better option for you because you also get that cash flow. And this is where you got to find the right strategy for you. For me, I like cash flow. That's why 75% of my investment portfolio, not my stock market portfolio, but my total investment portfolio are cash flow producing assets. And in my stock market portfolio, I have a lot of ETFs that pay me with cash flow, and I own some companies that also pay me with cash flow. Because for me, I like cash flow. Most of my investments are cash flow producing. Are all of them cash flow producing? No. But most of them are, because I like that cash flow, because the advantage of this cash flow is you can go out and buy this thing and it will continue to pay you even when you're going out and sleeping, or you're going out on vacation and you're going out and traveling, you're continuing to get the cash flow. For me, I want to have a system where my cash flow is funding my life. That way now I don't have to worry about my money because I own assets that are paying me with cash flow. That's why I like cash flow. And then the third thing you have to decide is, what type of investor do you want to be? Do you want to be more of a passive investor, or do you want to be more of an active investor? An active investor is what I call somebody who's now actively investing in individual companies, where now you're researching the company, you're investing in this company for the long term, and you're going to keep up with this company. A passive investor is where now you set up a system where every week, every 2 weeks, or every month, you're just buying more of the funds, whether it's ETFs, mutual funds, or index funds. You're just buying more of these funds no matter what's happening, and this is consistent, it's passive, and it's automatic. Now, you don't have to pick one. I have both, a passive investing system and an active investment system, where now I'm looking for individual companies to invest in. And I also have a system where every Wednesday I have money that's leaving my checking account that's automatically invested into my portfolio of ETFs. And this happens no matter what, whether the market's up, whether the market's down, whether we're in a market crash, whether we're in a market boom. This strategy does not change. I guess the only time it might change is if you go through a market crash. Maybe I'll buy more, but that's it. This is where you have to find the right strategy for you, for how involved you want to be as an investor. Now, let's diagram this out so you know exactly what this looks like. Let me start by going over a few dividend-paying stocks. And again, as a reminder, I'm not telling you what to invest in. These are just examples. So at the time of recording this video, Verizon is paying out a 7% dividend on their stock. McDonald's is paying around a 2% dividend on their stock. Bristol Myers, the healthcare company, is paying around 3.2% dividends on their stock, and then Apple is paying around 0.5% of dividends on their stock. Now, what does this mean? This means that if you go out and invest $100 into a company that's paying, say, a 7% dividend, that means for each $100 that you invest over the course of 1 year, you're going to get $7, which is 7% of $100 in cash flow just for owning that stock. That doesn't include the stock price going up or down. That's just the cash flow that you're getting. Now, this percentage can change because the real amount that you want to pay attention to is the dollar amount of the dividend that you're getting. Now, this dividend that you get is typically paid out every quarter, meaning every 3 months. So every 3 months you get a payment, and that payment would be 1/4 of whatever the total dividend amount is that you're getting over the year. And if you don't want to invest in individual companies, you can also look at investing in things like ETFs. Now, here are again some examples, not telling you what to invest in. Number one is SPY. This is an ETF that gives you exposure to the S&P 500, again, which is a group of the 500 largest companies on the stock market. At the time of recording this video, if you invest in SPY, the S&P 500, you would get about a 1.5% dividend. And when you invest in this one ETF, you're getting exposure to the 500 biggest companies in the stock market. Then you have DIA, which is paying around a 2.8% annual dividend right now. DIA gives you exposure to the Dow Jones Industrial Average, which is a group of about 30 companies that are spread across different sectors across the stock market. This is one of the most commonly tracked indexes when people talk about the stock market. If you've ever heard of people talking about the Dow Jones, well, this tracks the Dow Jones. Then you have QQQ. This is another ETF that tracks the NASDAQ. The NASDAQ is a group of 100 non-financial companies. Most companies currently in the NASDAQ are tech companies, but it's a group of 100 very large non-financial companies at the current time. It's paying around a 0.6% annual dividend. And then we have VYM. This is an index which tracks high dividend paying companies. I started because this is an ETF that I'm personally invested in, just so you know as a disclaimer. So this invests in companies that are paying out dividends. So if you're looking for cash flow, this is an ETF that focuses on investing in cash flow producing companies. Currently, they're paying out just over a 3% annual dividend. Before I go on to the second asset class that you can consider investing in, if you do want to learn more about how to actually start investing with a step-by-step guide on how do you start generating cash flow and how do you start investing even if you don't have a ton of money, again, we have a free ebook through Market Insiders that goes through how you can start investing and start generating this type of cash flow. The ebook is completely free, so if you want to read this ebook, I got the link to how you can join down in the description below.